Hello, I am Gerren Benoit with Robbie, Breaux and team, and today I'll be talking to Miss Tracy with Assurance Financial. We're going to give you some tips and tricks if you are a first-time home buyer. Hello, Tracy.
Hi, Gerren. How are you?
I'm good. How are you?
Great.
Awesome. So, if I'm a first-time home buyer, how much money do I need to put down as a down payment?
It's a great question. It's a common misconception that you have to put 20% down to buy a house. And in most situations, that isn't true. It certainly helps to put more money down, but we have a lot of great programs that offer 100% financing where you may not have to even supply a down payment to purchase a home. We have programs like rural development, VA. We also have some great down payment assistance programs that can help with not only down payment, but sometimes the closing costs as well. So 20% isn't always required. As little as 0, 3%, 3.5%, and you can go up from there.
Awesome. And would you recommend that I pay off all of my debts before I get pre-qualified?
No. This is what I tell everyone who even mentions that they may buy or refinance a house one day, is that whether you think you're going to buy a house today or a year from now, let me look at your credit report now. It doesn't cost you anything except about 5 minutes.
Okay.
The credit report pull is free. There's no upfront charge for that. But this will allow me to take a good look at your credit report to help you better prepare for the future and for buying a house. If you pay off your debts, what happens is that may potentially cause the account to close, and then that ends the credit history, which can have a negative effect on credit. Now, in some situations, it is good to pay off debt or pay down debt. But rarely do we want clients to close all of their accounts.
Right. And about how long does the loan process take?
From start to finish, let's say you got pre-qualified, which can take 5 minutes depending on the situation with the borrower, and you found a house and you're under contract. Average turn times for our industry are about 30 days.
Okay.
We could close with a good file, no major road bumps, 2 weeks. So it can be a really fast process. Sometimes that happens in a situation where a borrower is selling and buying at the same time, and maybe they have a cash offer on their sale, and those people really want to get in the house ASAP. So we do everything we can to accommodate. We'll speed up their buying process, speed up all the orders that we have to make on the file, and then get them as to closing as quickly as possible so that they can maintain that steady flow and not lose that cash buyer.
Okay, nice. Good. And what documents do I need to have in order to get a loan?
That will vary depending on the loan product and the borrower. But a basic loan file, I tell everybody it's rule of 2. 2 years W-2s, 2 most recent bank statements, 2 pay stubs, and maybe sometimes we need tax returns for 2 years.
Okay.
And then your driver's license.
Awesome.
So pretty basic.
And I heard you mention that I can be pre-qualified in as little as 5 minutes. How do I do that?
It's very easy. You can either give me a call and I can take your information over the phone.
Okay.
Or I have a free mortgage calculator app that the borrower can download, and they could apply online and do it that way. A lot of my borrowers work offshore, or they are nurses who work shift work, and sometimes it's difficult for them to talk during regular hours.
Okay.
So we try our best to accommodate everyone. So in a situation like that, we have our online application process they can go through and apply that way.
Okay,
Yeah.
Awesome. What is mortgage insurance?
Mortgage insurance. Anytime you purchase a home and you don't put 20% down, you're required to pay mortgage insurance, also known as PMI, private mortgage insurance. Basically, what that is for is that backs and insures the loan against default. Okay. So FHA has their own set mortgage insurance cost, and FHA backs and insures mortgages. Okay. On conventional loans, same thing. If you don't put 20% down, then the loan's more risky for the investor, so at that point they require mortgage insurance. Mortgage insurance can be handled several different ways. You can pay it monthly until you've reached 20% in equity, provided you have on-time payments. You can also pay it up front, which if you're going to be in the home for a prolonged period of time, that's sometimes the least expensive way to handle it. So we give our borrowers all the options. We tell them which option we think would save them the most money, and then let them make a good decision for themselves. But typically, when you don't put 20% down, you have mortgage insurance. And the mortgage insurance cost will vary depending on a lot of different factors. Loan amount, percentage down of down payment, loan terms, 10, 15, 20, 30 year, as well as credit scores.
So Tracy, lastly, how can we get in touch with you?
That's easy. You can Google me, Tracy Lasserre at Assurance Financial, or you can call my direct line at 337-456-8741, and my email address is tlasserre@lendtheway.com.
Fantastic. Well, you gave us some great information today, and hopefully, if anybody has questions, they'll contact either me or you and
Great.
get this process started.
Yeah, call us. Thanks.